Hi everyone, welcome back. Today we are going to talk about the concept of inflation. Inflation is one of those key macroeconomic indicators that you've probably heard a little bit about, especially lately in the post-pandemic era. We've been talking a lot about inflation. It's one of the key goals that the Federal Reserve, our central bank, really works on managing. So today we're going to really do a deep dive into it. We're going to talk about how to calculate inflation and what it means. And basically what we're going to be looking at is how price levels change over time. That's what inflation is. It's the measure of the change in price levels. And also it's going to give us some information about purchasing power, interest rates, and other things. It helps us differentiate between real and nominal variables, and it helps us track cost of living. So we'll talk about what inflation is, why it matters, how it's calculated, what's included. We'll talk about why people might be concerned with it and why economists may or may not be concerned with it. And we'll do a little bit of an international comparison, looking at U.S. inflation compared to a couple of other countries. There's a decent amount of new terminology here, but some of this stuff is stuff you might be familiar with. So things like an adjustable rate mortgage, baskets of goods and services, which is what we use to calculate inflation, consumer price index, cost of living adjustment, GDP deflator, hyperinflation, which is a really extreme case of inflation, and a couple of the biases that arise from inflation. So that's what we'll be looking at. So go ahead and grab your gigantic textbook or your slides, your notes, or just open up the OpenStax textbook online, and we'll go ahead and get started. Okay, so let's get started. So this is chapter 9 in the Principles of Macroeconomics textbook from OpenStax, which you can, of course, always access online. And basically what we're going to be doing here today is talking about how inflation is tracked, how we measure changes to the cost of living, and then we'll talk a little bit about how the United States and how other countries have experienced inflation over time. We'll talk about the confusion around inflation, basically in terms of who worries about inflation and whether we should. And then we'll talk about indexing and what the limitations of it are. And basically that's one of the uses of inflation. And when we come to this question of why we care about inflation, one reason is because in its extreme, in what we call hyperinflation, inflation can be really problematic. And there are basically a handful of situations of true hyperinflation in history. And one of the more recent ones is the story of Zimbabwe. So this is a picture of a Zimbabwean $100 billion bill. That's a pretty big bill. This was issued in 2008, and at the time there were even $1 trillion Zimbabwean bills. These bills, even though they had huge amounts of money, right, large numbers written on them, were essentially useless. At one point, at the peak of Zimbabwean inflation, 621 billion Zimbabwean dollars was equal to $1 US. And so eventually, Zimbabwe experienced so much inflation that they gave up control of their monetary policy and allowed foreign currency to be used for purchases and for exchange in their country. So that's a case of some of the highest inflation rate we can see. Basically what they saw was prices doubling overnight. And just to really sink that in, I actually have some other slides that aren't in the OpenStax textbook that I want to show you that I think are really instructive. So the other cases of hyperinflation are Germany after the World War, and we saw some hyperinflation in Venezuela a couple of years ago. But what we see here is in Zimbabwe, there was so much inflation that if we compared Zimbabwean dollars to US dollars, we saw that month to month, the quantity of Zimbabwean dollars needed to be equal to $1 US was exploding. These were real signs that people had in the bathroom saying, don't use Zim dollars as toilet paper. So that gives you a sense of how useless the money was. And here you can see a $100 trillion Zimbabwean bill, the amount of currency needed to buy a loaf of bread. Here's a child with just stacks of money. And here's a literal wheelbarrow full of money being used to try to go around and purchase things. And so I feel like that really sinks in the idea of how bad hyperinflation is. Again, it's pretty rare, but it is something to worry about. And it's one of the reasons why we care about inflation. So what is inflation? Basically, inflation is a general and ongoing rise in the level of prices in the entire economy. It's not about a single price, it's about the price levels overall. And so this pressure for prices to rise is kind of a part of a normal economy. And it's not that one price is rising, it's that the total prices in the economy are rising. And it comes from basically measuring the price level of a basket of goods and services. And so I drew a little fake basket here. We don't obviously mean a literal basket, but what we're saying is think about what the typical consumer needs to purchase in a given month to survive. Housing, clothing, food, services like personal care services, education, entertainment. All of those things are collected into that basket of goods and services, and then we track the prices over time to see and measure inflation, to measure the change in the overall price level. It's computed using weighted averages, meaning obviously the price of bread is not going to have the same impact on a person's budget as the price of housing. And what we're going to talk about today and what we'll look at, and I'll give you all an example of, is how we actually calculate inflation. So the way we tend to calculate inflation is using an index number. And indexes or indices are unit-free numbers that are derived from changes over time. When we talk about inflation, we're going to be using something called the Consumer Price Index. And that means we're going to look at the price level over several years, and it's going to allow us to measure the magnitude of change, not the value. And so we're taking sort of the dollar sign out of it and instead getting this percent change in inflation overall. And so to calculate an index, we need to know what the cost of and the value of our basket of goods is over time, over several years. And we need to pick a base year, and that's really important. When you pick a base year, that becomes your sort of center value, your 100. And the level of the index value for the base year is 100. And then anything above 100 represents an increase in the price level. Anything below 100 represents a decrease in the price level. And indexing is just a really easy way to show that magnitude of change and that direction of change without having to think about the units in a more specific way. And so when we calculate inflation, what we're going to look at is we're going to look at the percent change in index values between years. So if I wanted to get the inflation rate for 2022, I would look at the level of the index in 2022, subtract the index in 2021, and divide by 2022. And then, divide by 2021 and then multiply by 100. So let me put that formula up here. Let's put an example up here. And the idea is really all you're doing is you're calculating a percent change, right? I could use the CPI, which we'll talk about, the Consumer Price Index in 2022, subtract the value in 2021, divide by 2021, the previous year and the current year, or the year I'm interested in, and then multiply by 100 to get a inflation rate from 2022, between 2021 and 2022. Okay? Does that make sense? Let me know, because this is something that's really fun to do an example with, and so I'd love to show an example. So what is the CPI? The CPI, or the Consumer Price Index, is a measure of inflation that is calculated by the U.S. government. The Bureau of Labor Statistics goes out and calculates the price level for a fixed basket of goods and services that they believe represents a consumer's purchases. They do sometimes change the basket of goods, but what we're trying to calculate is, what we're trying to get at is the cost of that basket of goods over time. How much does it cost for an average consumer to live in 1999 relative to 1979, relative to 2009, relative to 2029, right? There's a couple of problems with the way we calculate this, though. If we fix the basket, then that means that we aren't going to notice any other changes. So some of the changes we might see and we might miss with a fixed basket are the substitution bias and the quality and new goods bias. And so the substitution bias is going to happen if I'm comparing an orange to an apple. I don't know where my red pen went. But I suppose that's not the most important thing in the world. There we go. If I always buy 10 apples and 10 oranges, and they're $1 each, then my CPI might include a basket with 10 apples and 10 oranges. But what are consumers going to do when the price of apples goes up to $2? Are you going to buy as many apples, or are you maybe going to buy fewer apples and more oranges? That's a substitution effect. The substitution effect says when the price of one good goes up, we're going to tend to see an increase in consumption of the relatively less expensive good and a decrease in consumption of the relatively more expensive good. Does that make sense? And you can think about that in your own life. As prices go up, you select away from the most expensive options to try and rebalance your budget. So one of the problems with the CPI is this fixed basket means it's not going to take into consideration that substitution bias. It's going to tend to overinflate the effect of rising prices because it's not going to allow for this change to happen. The other thing that I think is really important to think about is what's called the quality and new goods bias. And to think about this, think about comparing the CPI of 1980 to the CPI of, say, 2020. First of all, think about the average goods and services that a person in 1980 was buying. They did not have a cell phone. They might have had a computer, but if they did, it would be really expensive and really inefficient. They might have had a car and expenses for transportation, but the fuel efficiency of the vehicle would have been much different, and the comfort and the variety of vehicles at the time was very different than it would be 40 years later. When we fix this basket of goods, we're going to miss out on the variety of new goods, and we're going to tend to not have a way to measure the benefit to consumers of increased quality of goods. So think about your cell phone. Your cell phone you have today is probably many times more powerful than the average $1,000 computer in the year 2000. And so that quality of goods and the variety of new goods available are going to mean that the CPI is going to tend to overestimate inflation because it's not going to take into account the true benefit that we get from increased quality of goods and new goods. Does that make sense? So what we're doing is we're fixing a basket of goods to calculate the price over time to go ahead and measure our consumer price index. And what we're going to tend to see is that the CPI is going to measure our inflation rate for us, but it's going to tend to overestimate it because it's going to miss out on the substitution bias, and it's not going to consider the additional benefit that we get from increased quality of goods and increased variety of goods. Okay? And that's the thing that economists really care about. When we look at what is in the consumer price index, it tries to account for every aspect of the average consumer's expenses. So when we think about consumer expenditures, we want to think about how much money people are spending on things and how much those things cost. So one of the things that the CPI does is it weights the components. It says, listen, housing makes up a different proportion of my budget than clothing does. Hopefully you don't spend as much money on your housing as you do on your clothing or your transportation or your medical care. And so this graph here, this pie chart, shows the weight of the components of the consumer price index. So they assume that whatever the price change is for housing, that's going to have a big impact on a person's cost of living relative to a change in the cost of education or food and beverages or apparel. And I like this comparison right here between clothing, apparel, and housing because you can see they're two very different segments, right? Apparel only makes up 3% of the consumer price index, and housing makes up 42.4%. And so if clothing prices go up by a lot, it's not going to have a big impact on consumer price index because clothes make up a small portion of your basket of goods and services. On the other hand, if the price of housing goes up by a lot, let's put a little house in our basket, that's going to have a big impact on the CPI, even if the cost of housing only goes up a little bit, because it makes up such a big portion of our monthly expenditure or our annual expenditure. So of the 8 categories used to generate the CPI, housing has the highest component. It's the highest weight. The next category with the largest weight is going to be food and beverages. That makes up 15% of the consumer price index. And then we have other goods and services, apparel, and other low one is recreation. The next biggest one after food and beverages is going to be transportation, and then medical care, education, and communications. And so the idea here is that we spend different proportions of our budget on each of these categories. And so price changes in each of these categories is going to have a different effect on our cost of living. And that's the whole goal here. We want the consumer price index to be an efficient measure of the change in the cost of living for the average person. Cool? So, when we measure the cost of living and we have this value, the CPI, that's calculated by the Bureau of Labor Statistics, one of the things that economists like to calculate, they like to calculate what's known as the core inflation index. And the core inflation index is calculated by taking the CPI and then excluding the most volatile prices. So energy and food prices are going to have the most volatility. They're going to tend to fluctuate the most. And so when economists look at this core inflation index, what they're trying to do is look at the most stable prices. So if energy prices, and you can see this, right? Gas prices change day to day. That might not be a good measure of where prices are really going. But the cost of other things that don't include those core inflation index items, those are going to be a better measure of the trend that prices are taking in our economy over time. And so the core inflation index is the sort of preferred gauge of inflation when making policy decisions, whether you're an economist or a policymaker in the government. And so we can use that core inflation index as a tool to help us understand inflation better. And the big takeaway here as we move through these ideas, talking about unemployment in the last chapter, talking about inflation in this chapter, talking about GDP the chapter before, all of these measures have flaws and shortcomings, but they're all also still useful tools to understanding the economy. And so we take them together, but we take them into consideration while remembering their shortcomings, right? Remembering that CPI and inflation measures are going to tend to miss that substitution bias. Thinking about unemployment, remembering its shortcomings. Thinking about GDP and knowing it measures productivity, but it misses some measures of quality of life. Okay? So, how do we improve the CPI? What are some ways to try to improve the CPI by taking into consideration the substitution effect and the quality/new goods bias? One argument is that we just need to allow for more substitution between goods. And the Bureau of Labor Statistics actually does do this. They have alternative mathematical methods for calculating the CPI. They try to periodically update the basket of goods, and some argue that we should update it more frequently, so we make sure we include things like computers, and let's see if I can draw. I don't think I can draw a cell phone. Here, this is a cell phone. Black brick. Boop, boop, boop. Yay! That looks like a book. So updating the CPI frequently is going to mean that we get a more accurate accounting of new goods and the diversity of goods, but it's still going to be flawed. We do believe that the substitution bias and the quality goods bias has been reduced over time, but it gets problematic because on the one hand, now we're reducing those biases, but on the other hand, it's going to mean that the CPI doesn't compare over time as well. Economists estimate that the consumer price index still probably overstates inflation by about 0.5 percentage point a year. So about 0.5 percentage point per year, less than what we're actually reporting, give or take, depending on the substitution effect and what kind of new goods are really on the market. Okay, so there are other indices that can be used to tell us about changes in prices over time. The CPI is our most common and frequently used measure of inflation. We also have the Producer Price Index, or the PPI, and that's a measure of inflation based on the prices that producers buy for their inputs. So it's going to depend on industries, but it's going to also depend on the stages of processing of the given industry. But it's basically just looking at how input prices change. The International Price Index is a measure of inflation based on imports and exports, so getting a more international perspective. The Employment Cost Index is a measure of inflation that's just based on wages paid in the labor market. And then the GDP deflator is another measure of inflation that's pretty close to the CPI, but instead of using what consumers buy, it looks at the level of inflation in the GDP components. So remember from 2 chapters ago, GDP includes consumption spending, investment spending, government spending, and exports minus imports. So the GDP deflator is measuring the increase and decrease in prices of those elements, of those things. So it's not just consumption, it's also business expenditure, government expenditure, and the goods and services we sell to other countries. Consumer Price Index does not look at business or government expenditure, but it does allow us to consider inflation in the cost of imported goods, not just domestic goods. Okay? So those are some of the big ways that we measure inflation. Now we want to talk about how other countries experience inflation and how the U.S. experiences inflation. We've generally had pretty moderate measured inflation over time in the United States. We do tend to see waves of inflation, especially after massive expenditures. World War I and World War II, we spent a lot of money, and the government funding of those wars led to pretty high inflation. We also saw really large inflation in the 1970s in response to energy prices really being very high. We can also talk about the idea of deflation. Deflation is sort of the opposite of inflation. So that would be if the prices started to go down rather than come up. And that's not necessarily a very good sign either. We had periods of deflation or dropping prices, usually in massive recessions. So in the 1920s and in the 1930s, following the Great Depression, we saw periods of deflation. We actually saw a little bit of deflation in 2008 in the Great Recession too. And if you'd like, you can always look this up. It's super awesome. First of all, if you go to the OpenStax textbook online, there is a CPI calculator or an inflation calculator there that helps you look at how to calculate inflation. But you could also always go to the Federal Reserve and look at their calculations of inflation. They save the CPI data and show it over time, and that's a nice place to really visualize it. Hyperinflation, like we talked about with Zimbabwe, is an explosion in inflation. It's incredibly high inflation rates that usually tend to occur when economies shift from a controlled economy to a market economy, or when there's a period where there's a huge level of government spending that is increases the money supply and really devalues the currency. The United States has never had a period of hyperinflation. The closest they got was during the Civil War between 1860 and 1865. Confederate states, after they left the Union, created their own currency and then distributed too much of it and experienced really high rates of inflation. Which is basically, if you think about it, high rates of inflation, hyperinflation just means the dollars, the bills, the money has less value. So thinking about that picture of the Zimbabwean child with just stacks of money, that's not a good sign, right? So here we've got some graphical representations of U.S. inflation rates over time. Here's the U.S. price level from the 1940s up to the 2020s. And here is the U.S. the U.S. inflation rate. And so we can see inflation fluctuates. It tends to be positive as the price level tends to rise, but there are periods of relatively low inflation. And I'm going to pause it right here and take us off of the textbook and go and show you guys the Federal Reserve's inflation calculator, because I think they do a really great job with their graphs. Okay, so I am looking up the Federal Reserve, which is also called, the St. Louis Federal Reserve also is called FRED. And I'm going to look up their inflation over time. And it's really easy. There's tons of this data is available for free online, which is really nice. And so you can always look this stuff up just to get a sense of it. There we go. And you can always also download this data if you were ever interested in that. But I like to look at it because it tells us, first of all, here we have our inflation rate for this was updated last May 9th, 2023. And inflation was 8% over the previous period. And we can see the inflation rate based on consumer prices over time. We can see peaks in 1970 and then a recession and some decreasing inflation, but still positive. And then rising prices again, really high rates of inflation in 1975, and then again in 1980. And then we had what was called Volcker disinflation, where then Federal Reserve Chair Paul Volcker lowered inflation with a lot of really tight monetary policy, which we'll learn about later on. And then we can see relatively controlled inflation. We do see over here in 2008, like I said, inflation fell from 3.8% all the way down to barely negative 0.35% in 2009, and then back up to a very moderate, a little bit over 3%. And then over here we can see in 2020, we did see inflation fall to a low level, but it never truly got negative. It went down to 1.2%. And then in the early 2020s, we've seen inflation be relatively high. And so that's a nice place to get that information and take a look at it. And so you can use that as a resource if you want to learn a little more about inflation. Okay, so back to the U.S. inflation rate graphs in the textbook. And again, as I said before, if you're looking at the digital textbook, you might see more updates than you might see in the slides or I have in the textbook. So for example, I have the physical book and it only goes up to 2018. These slides go up to 2020. If you're looking on the OpenStax book, it might go up to more recent years and periods. But you can see how inflation fluctuates over time. You can see those same peaks that we saw on the Federal Reserve webpage in 75 and in 80, and then the deflation. There's that little negative bit of inflation in the post-Great Recession housing bubble era. But overall, the trend is a lot more like the graph I drew at the beginning, right? It looks a little bit more like this, where it trends up overall. And that's not necessarily a bad thing. That's about what we expect. If we compare inflation rates across countries, we can look at relatively low inflation for most of the countries in this little tiny sample. So we've got blue is the United States, this sort of purple color is Japan, green is Germany, and the UK is yellow. And the UK mimics a lot of the US. And so does, you can see the UK and Japan both had this very exaggerated period of really high inflation, 20 to 25% inflation rates during the 70s. Whereas for the US, our version of incredibly high inflation was like 10, 15%. And then you see Germany does a pretty good job. They engage in really stringent monetary policy. And so you can see their inflation rate stays pretty low over time relative to everyone else. But there's also a little bit of a trend as these four countries respond to global events with changes in their price level. And that just speaks to the fact that, in the modern era, no country really has their own isolated economy. We're all very integrated through trade and other things. We can also look, where did we go? Bloop, there we go. These two charts look at countries with relatively high rates of inflation over the period of 1981 to 2021. Although here we have the inflation rates from the 80s and 90s for Brazil, and you can see just the little tiniest bit here of Russia. And then from the 90s to the 2020s, you can see Russia in blue with very high inflation rates, China's relatively flat inflation, and Brazil's fluctuation. We can think about these inflation rates as being a product of a couple of different things. One of the things that a lot of economists argue is that it really is a function of the policies of the country, what inflation rates look like. You can see here this really high rate of hyperinflation of Brazil in the 90s, and then this period of relatively high inflation in Russia in the late 90s and early 2000s. And so it's just a nice way to look at how these things might happen. It tends to be argued, especially by economists and policymakers, that we see a lot of this inflation come from countries that have maybe shortages, perpetual shortages that cause prices to rise, right? If you can't get enough of something, if there's a lot of shortages of essential goods and services, then the prices of those things are going to go up. And economists really argue that one way to protect against this is to have a more market-based economy. And so the argument here is that, China's economy evened out a lot more when they added in more elements of a market economy. The last section we want to talk about here is the confusion over inflation. The tricky thing about inflation is that not everything moves together. So when we think about other economic variables like prices, wages, and interest rates, they might adjust to changes in inflation over time. And so think about prices going up. Are they all going to go up at the same time? No. And then when they do go up, do wages go up automatically when prices go up? Not necessarily. And then the response of interest rates to inflation is also going to be important. When we start to talk about the market for loanable funds and borrowing, we'll talk about real versus nominal inflation rates. And inflation rates can have a really big impact on real interest rates, and that's going to have some redistribution effects for borrowers and lenders. And so if we go into the textbook in the chapter, in the OpenStax textbook, they have this little section called the land of funny money. And basically they give you this hypothetical situation. What would happen if if we woke up tomorrow and all of our prices everywhere, everything went up by 20%. If the price of gas went up by 20%, the price of food went up by 20%, but wages went up by 20%, interest rates went up by 20%, everything increased by 20%, what would be the effect? There wouldn't be one, right? It would just sort of be like we scaled everything up. That wouldn't be a problem. The problem is that things don't adjust at the same time. And so there can be confusions about the price signal. Are prices going up because of inflation? Or are prices going up because our goods are really popular and we need to hire more workers? The unintended redistributions of purchasing power can come from wages adjusting more slowly than prices, but also from as interest rates stay the same and inflation goes up. That can tend to benefit borrowers by eroding real interest rates. And it also makes it really hard to plan long term. And this is one of the big things that we think about when we think about economic growth and stability. One of the keys for planning in the future and for economic growth is that you have to borrow against the future to engage in really good economic growth, whether you're trying to build a new business or build a new factory or going to school and borrowing money. You're making those decisions based on an expectation of the future. And when prices start to fluctuate irregularly in the future, that can affect certainty and that can affect your decision about whether to just consume all your money now or save and plan for some future expenditure. So that's a real problem. That's one of the real costs with inflation. That's one of the things that that economists really worry about. So who is hurt by inflation? First of all, people who hold cash are going to tend to be hurt by inflation. If you're holding on to cash, basically that bill, right, if I've got a $1 bill here, as prices rise, this $1 bill buys less and less. It becomes less and less valuable. And so if I'm not earning some kind of benefit of it, if it's not growing along with the interest rate, then I'm going to be harmed. You can also be hurt by inflation if you have a financial asset or an investment with a nominal return that doesn't keep up with inflation. So let me give you a little baby example here. If I have an investment and I'm earning 10% per year on my investment, and inflation is 3%, then my real benefit is, okay, I'm getting 10% revenue on this investment, but the purchasing power of it is going down by 3%. Okay, well, I'm still getting a net benefit of 7%. What happens when inflation goes up to, say, 12%? Now, I'm getting a 10% return on my investment, but that money is losing 12% of its value in terms of purchasing power. So my net benefit is now actually negative 2%. It's better than it would be if I wasn't earning anything, but it's not as helpful, right? It's not earning what I think it's going to be. The nominal return when adjusted for inflation is actually negative. Another problem that we kind of talked about when we talked about labor markets, but wages tend to be really slow to adjust, right? We see wages, there's sticky wages, especially sticky wage adjustments downwards, but also sticky wages adjustments upwards. So when we see inflation and prices rise quickly, we're going to tend to see a lot of consumers hurt because their wages are not going to rise at the same pace that inflation rises, at the same pace that prices rise. And then people who have some kind of pension. Have you ever heard the expression, I'm living on a fixed income? The idea is if you're retired and you have a private pension, they say, okay, well, we're going to give you a set amount of money once you retire every month for the rest of your life. Well, if that money stays the same but prices go up, what you can afford to buy with your pension gets smaller and smaller, and that's going to cause harm. Ordinary people can also benefit from inflation. So the idea here, this is not super well explained in the slides, so I'm going to try and explain it to you now. Basically, there's the real interest rate and the nominal interest rate. And the nominal interest rate is the one that you see on a credit card statement or an investment return or on your student loans. And so let's say I've got a nominal interest rate of 20% that I have to pay back on a loan I've taken out. That's a pretty big interest rate. That means that I owe 20% of what I borrowed to the lender. But the real interest rate is going to be equal to that nominal interest rate minus inflation. So if inflation is, let's pick some colors here. If inflation is at 3%, then my real interest rate is 20 minus 3, or 17%. And my lender will have calculated that. What they might not be able to do is adjust quickly to a drastic change in inflation, right? If the inflation rate suddenly jumps up to 13%, all of a sudden, in real terms, I'm only paying 7% on that loan. And so that can make borrowers better off because they can repay their loans in dollars that are worth less than originally expected. So the money I end up owing tomorrow is worth less than the money I borrowed yesterday. Does that make sense? Think about it this way. Think about the Zimbabwean inflation. When prices are doubling every day, let's say I borrow $100 from you to buy a concert ticket this week. Next week, I pay you back that $100, which now can only buy a half of a concert ticket. You need $200 to buy the same concert ticket I bought a week ago. Who's hurt by that exchange? I win and you are hurt, right? I got to borrow money and buy a thing that now costs so much that by the time I pay you back, you can't buy the same thing that I bought, right? You can't replicate that exchange. And so that's another way that inflation can harm individuals. The other way we want to look at inflation is we want to look at it in terms of purchasing power and wages. And the textbook has an example of this, a chart that compares the minimum wage in terms of real terms versus nominal terms. And remember, when we're thinking about the difference between real and nominal, the way I always like to think of it is nominal is what you see around you. It's what's reported, it's what's on your paycheck, it's what's on your bank statement. Real is after we go in and adjust for inflation. That's what the economists want to talk about. So here we have the U.S. minimum wage adjusted for inflation in terms of real 2010 dollars. So basically what we're seeing here is in 1965, the minimum wage could have bought you a little bit over like $8.25 worth of goods. Over time, even though the federal minimum wage has gone up in nominal terms, right? It has gone up from $2 in the 70s to $7.25 in the current era, $7.25. The purchasing power of that $7.25 has gone down because the minimum wage has not kept pace with inflation. So increases in the minimum wage between 2008 and 2010 kept the decline from being worse, but we still see that the purchasing power has gone down relative to the 60s and 70s. So why else do we care about inflation? One of the big takeaways in economics is that prices are information. Prices convey information between consumers and producers about willingness to pay, cost, and exchange. It's how we make decisions, right? It's how we determine whether to make more of something or less of something, whether we want to buy something or not. Inflation blurs that message. It makes it harder to tell what's really going on. Are prices of strawberries going up because they're harder to produce, or are they just going up for some other reason, right? Am I willing to pay more for strawberries because I value them so much, or did I just not expect the price to go up and I'm going to change my behavior next time? Inflation also means that we're going to see price signals more vaguely. We're not going to be as clear about what price signals mean, and that's going to lead to an increase in uncertainty. And uncertainty is bad. It's bad for businesses and it's bad for individuals because uncertainty makes it hard to plan for the future, and it makes it hard to really tell it makes it hard to tell what's really going on and make good decisions in the long term. So inflation in general is going to make it harder to plan for the future because inflation tells us that the prices tomorrow or a year from now or 40 years from now are going to be different, but we don't know by how much. And that's where we get to the real issue that economists care about with inflation. It's not that we want no inflation. We want inflation to be predictable. If inflation is predictable, then you can say, oh, well, I know because the inflation rate tends to be 3%, what it's going to be a year from now, 10 years from now, 20 years from now. But if the inflation rate is fluctuating from 0 to 15%, then it's going to be really difficult to plan for the future, whether it's investing in education, starting a new business, expanding a company, retiring. All of those things are going to make it harder. Inflation makes it harder for you to make those decisions. And even when we think about innovation and research and development, that requires putting off consumption now to save money for the future. And inflation can really make that problematic. Okay? So here we have a little bit of another graph that looks at the US inflation rate relative to productivity. And over the last several decades, looking at the United States from the 60s to 2020, there have been lots of times when rising inflation has been closely followed by lower labor market productivity rates. And then lower inflation is responded to with higher productivity. And so there are some economists who think that maybe there is some moderate inflation might help the economy by making wages and labor markets more flexible. If inflation rates are high, firms are going to be willing to pay a little bit more, and that might incentivize higher productivity. There's not strong evidence for this, but it is one of the things we can look at and think about when we think about the benefits of inflation. So, the last thing we want to do today is talk about indexing and its limitations. So we talked about indexes, an index being the consumer price index, a measure of a number where we look at a base year and look at it over time and see the value either go up or down based on that base year, right? This is different. This is indexing. And what we mean by that is we are tying or adjusting a value to the index. So if we have the consumer price index, our measure of inflation, our measure of cost of living, sometimes we can tie a value to the consumer price index so that it adjusts automatically. And so we can see that with wages, prices, and interest rates. And the two most common versions of indexing in private markets are what are called COLAs, or cost of living adjustments. And that's when you have it built into your employment contract that whenever inflation changes by some amount, your wages will also. And so the idea is, okay, if inflation is going to go up 12%, then my wages also need to go up 12%. The other version of that is what's called an adjustable rate mortgage, and that's a relatively new invention. Those sort of came out in the early 2000s, late 90s, and they are a situation where a borrower is trying to avoid this situation. And so when you have inflation go up by 10%, you'll adjust the nominal interest rate in order to protect the real interest rate. And so in this case, the interest rate is going to vary with market rates. It's going to adjust, which is in contrast to what used to be the most common kind of mortgage, which is a fixed rate mortgage. We also see indexing in some government programs. The U.S. income tax code is designed so that the income tax levels will adjust with inflation automatically. Some Social Security benefits are indexed over time to the consumer price index. And the U.S. government also offers indexed bonds. And so a bond is an investment, right? You buy it, you give the U.S. government some money, and they promise to pay you back. The U.S. government offers indexed bonds, promising to pay back a real interest rate return, protecting against inflation in that same way. So that's what we know about inflation. That's it. So hopefully that was a little bit of fun, a little bit interesting, gave you a new sense and understanding for what inflation does and what it means. We'll talk more about inflation a lot as we dive deeper into our macroeconomic models. It's going to be important for understanding the goals of our central bank It's also going to be important for helping us make sure we're using real variables rather than nominal variables, and it's a really important measure of our economic health and well-being. If you are interested in an example for how to calculate inflation, how to use the CPI to make calculations, there are examples in your textbook, and I'd be happy to throw an example up on a video together for you. Let me know what questions you have. Otherwise, I'll see you next time. Have a great day.